Good morning, everyone. Thank you very much for joining me for the August SURF webinar. What I plan to cover today we'll look at SURF's default investment strategy. So just a reminder of what it is, what the differences are between the three ranges. Then we'll look at the performance of all three of these ranges. And then the focus of today's session will be on risk versus return. So investment theory tells us that we have to take on a little bit of risk in order to get high returns over the long term. So we will just unpack what is risk, how it's calculated, how do we stack up on some of the risk metrics. So I'll cover some of that after the investment performance. And as always, please feel free to type in your questions and I will handle them at the end of the session. If there's not enough time to cover all of the questions, which I'm sure there will be, but then in that case, I will get back to you over email. So just a reminder of SURF's investment strategy to start with, but before SURF's investment strategy reminder, I just want to again cover our mission and vision statements. So, I mean, we wake up every morning wanting to, really think about exciting, innovative products that can assist retirement fund members to plan for a comfortable retirement. So we really try to restore that confidence in the retirement fund industry by creating these innovative products. And our vision in our ideal world would be to enable life-changing and dignified retirements for more and more South Africans. So let's touch on the default investment strategy. So for every member that does not make a member investment choice of their own, they will be defaulted in a life stage model. The life stage model has been chosen as a default option for the Sygnia Umbrella Retirement Fund by the Board of Trustees. And every single employer then decides on one of the three defaults as their employer's investment strategy. We do understand that members' circumstances may be quite unique. Some members want to retire much later. Some members who can afford to want to retire much earlier. Some may, only be employed for a couple of years in South Africa and plan to immigrate. There's many, many reasons why members may feel that the default investment strategy does not work for them. So for that reasons, there is member investment choice that is allowed in the Sygnia Umbrella Retirement Fund. So members can create their own investment strategy. There's 18 portfolios to choose from. Members are able to switch as often as they want to. However, we don't advise that members switch very often. Retirement funding is a long-term game. You have to think about the long term. So you have this goal, depending on how old you are, it could be 10, 20, 30, 40 years away. And it's really good to find an investment strategy that works for you. Very often that is the default investment strategy implemented by the trustees, and to stick to that investment strategy. However, if you do want to switch or members do want to switch, there's no switching fees. And as I mentioned, you can switch at any time during the year. As many times, members can switch as many times as they would like. So what does the life stage model look like? Members are defaulted into a high equity type of portfolio while they still have a long term to retirement. What is that long term? It's 6 years. So anybody with more than 6 years to retirement, so younger members that have more than 6 years before their normal retirement date, will be defaulted in the 70 portfolios. As you start moving closer and closer to your normal retirement age, we will automatically transition members from the 70 portfolio to the 40 portfolio. So members will be defaulted from 70 to a mix of 70 and 60 to 60, and then so on right up until 1 year before retirement, when they will be invested in the 40 portfolios. Now, the numbers in the names of the portfolios are indicative of the approximate equity allocation. So in the 70 portfolios, you can expect 70% of the portfolio to be invested in equities. Equities are company shares. Whereas in the 40 portfolio, you can expect about 40% to be invested in equities, meaning that the other 60 is in safer type of asset classes. So all younger members will have a higher equity allocation, and older members that are closer to retirement will have a lower equity allocation. This will make a lot more sense, and the design will make a lot more sense once we unpack risk. Now, within the life stage model that the trustees have chosen for the umbrella fund, there's 3 different options. There's the skeleton range, the signature range, and the synergy range. But all 3 of these life stage models follow the same glide path, and the glide path is this de-risking from 6 years before retirement. Now, just a quick summary of some of the differences from a construction perspective. The skeleton and signature range are what we call a specialist approach to portfolio construction, whereas the synergy range is what we call a balanced approach. So essentially, if you look at the little diagrams, the specialist approach, Sygnia controls the asset allocation of the total portfolio locally and globally, meaning that, you know, based on our analysis and our forward-looking views on where we believe asset classes will go, we look at various metrics before we decide the exact percentage that should be invested in equities, bonds, cash, all the other asset classes. And then within each asset class, if you look at equities over here, once we've decided the percentage of the portfolio that needs to be invested in equities, we then go and look for the best equity managers and the best equity strategies that we want to include in the portfolios. Once we know the percentage that should be invested in bonds, we then look for specialist bond managers and bond-specific strategies. So this is the approach for both the skeleton and the signature range, where we decide the asset allocation up front. We then go and look for specialist managers that are very good at managing those asset classes or strategies if it's a passive investment. Whereas in the balanced approach, the offshore, the 30% that's invested outside of South Africa, is exactly the same as what you see in the skeleton and signature range, but it's the local portion, which is the bulk of the portfolio, the 70% that's invested locally in South Africa, where the asset allocation is then given to the asset managers. So if you look at the little diagram here on the right-hand side, you will see that you start with the portfolio, and this is just the local portion. You give a number of managers a certain proportion of the portfolio, and then the asset allocation decision is up to them. So once you give somebody like a Coronation, let's say 20% of the portfolio, it's up to Coronation how they want to invest between bonds, equities, cash, property. So they decide on the mix of asset allocation. So that's really just the portfolio construction differences. And the specialist approach, Sygnia controls the total asset allocation of the portfolios, whereas in the balanced approach, it's up to the asset managers and their views on the world that will inform the mix between equities, bonds, cash, and property, for example. Now, as I said, we will unpack risk a little bit later, but risk in simple term is the risk of capital loss. If you're investing in something like company share, you could buy a company share today at 50 Rand, and later on it might be at 48 Rand. Tomorrow morning you may wake up and want to cash out the share. It could be sitting at 47 Rand. So that is the risk of capital loss, the risk that you purchase something at a certain level, and at the time that you want to withdraw your money, that value has dropped. Now, we know that equity prices go up and down, and that is the reason why it is advisable when you're investing in riskier asset classes to be invested for the long term, so to have more of a long-term time horizons, whereas the safer asset classes, if you give your money to the bank, if you give them 50 Rand today, you know that you can go to the bank tomorrow and that 50 Rand will still be 50 Rand. You don't expect 50 Rand to go to 47, to go to 46, 45, and just move around that value when you're investing in cash. So for that reason, when we're looking at risk and return, we know the higher the risk of capital loss, the higher the return over the long term. Looking at this diagram, risk is on the horizontal axis. So the further right you look, the more risk there is, and return is on the vertical axis. The further up, the more return the portfolio is giving you. So if you think about money market, cash type of investments, they're very low on the risk spectrum, but you also don't expect a very high return. You don't expect to put your money in the bank today, the 50 Rand, and that 50 Rand to go to 60 overnight. We know that money market very much linked to interest rates. Interest rates are low, and money market doesn't grow quite as quickly as equities can over the long term. Then the portfolios that are suitable for members that are 1 year before retirement, the 40 portfolios, they are low on the risk spectrum, higher than cash, because there is about 40% invested in equities. And over the long term, you don't expect as high of a return of the 40 portfolios as you do from some of the more aggressive portfolios. Then the 60 and the 50 portfolios are considered to be medium risk. About half of those portfolios are invested in shares. In the 60, it's about 60% that's invested in company shares. So higher on the risk spectrum, further to the right, but you also expect a higher return from these over the long term. And then the default for every young member in the SURF fund is a 70 portfolio, depending on what the employer has chosen, but all the 70 portfolios, as well as the member investment choice portfolios that we have listed on the right-hand side of this slide, these are higher risk, but you do expect a higher return over the long term. So this really is the philosophy and the thinking around life stage models. Younger members have a long time horizon. They've got many, many years before they actually going to retire. So they can stomach the volatility. You can stomach the ups and downs of share prices. They can go from 50 to 48 up to 52. But over the long term, we know that higher risk assets do tend to grow, and that is the reason why younger members should be using the opportunity, the fact that they have a long time horizon to be able to stomach more risk with the volatility, but over the long term, you can expect higher returns and really returns that can help you with a comfortable retirement. Whereas with older members, if you 1 year prior to retirement, you wouldn't want the risk of capital loss. You wouldn't want a member to think that they are retiring with R1 million. The market crashes and that R1 million has suddenly become 900,000 or 800,000. So that really is the thinking and the philosophy around constructing life stage models. Now, if we have a look at the performance, these are the 70 portfolios that members can be expected to be spending the majority of their working lives in. And what this chart represents is 100 Rand invested once into each one of these portfolios, as well as the Global Large Manager Watch Median. So if you look on the top right-hand side of this diagram, you'll see that the one line is the Signature 70 portfolio. That's the darkest, almost brown line. Then the darker red is Synergy 70, and the lighter red is Skeleton 70. The Global Large Manager Watch Median is the median performance of the managers listed at the bottom. These are all very large managers, very well-known managers in South Africa. So it's well accepted in the industry that if you can outperform the median performance of these managers, then you have done better than the average manager, and your portfolio has done very well. Now, we can clearly see that all three of these ranges have outperformed this Global Large Manager Watch Median, so they've done quite nicely. But what we can also see is that, yes, this 100 Rand has grown since May 2012. The reason why we've chosen May 2012 as the starting point is this is the true starting point of the Synergy portfolio. Skeleton and Signature do have a longer term track record going back right up to 2007. So this is real performance. It's not back tested, and it is real actual performance of members that could have been invested in these portfolios since inception. So we can see that the 100 Rand has grown quite nicely in all three of these ranges. But what we can also see is that the growth has not been smooth. It's not a smooth line that you just see going up. There is ups and downs, and this shows you the volatility. So the volatility, as the example that I used a little bit earlier on, when you're investing in shares, something is priced at 50 Rand today, at 48 tomorrow, back up at 50, can go to 52. So share prices go up and down throughout the day, from day to day, from month to month. So you do expect volatility. These are higher risk investments relative to other asset classes like cash. So you do expect volatility, but over the long term, as is evident on this chart, the monies do grow when they are invested in higher risk portfolios. What's also quite evident to see is the this big dip. This was the big dip that we saw when all the lockdowns happened in 2020, the first quarter around March and April. There was lockdown in South Africa, there was lockdowns in many, many nations around the globe, and markets panicked. We had never lived through any event such as this, and investors were worried. Well, how can I invest into certain companies when their businesses are shut? How can we expect profits from these companies? There was a lot of question marks, a lot of anxiety and nervousness in the markets. So markets kind of fell, investors took their money, put it into safe type of asset classes like gold that are considered to, be a good store of value. But when markets recovered, members benefited from that dip, because every time that portfolios dip, if you're contributing the same amount into your retirement fund every month, you actually add a benefit, because if you're putting in 1,000 Rand every month, for example, now when the market is down, you can buy so many more shares with that 1,000 Rand rather than when markets are at all-time high, and you can see the recovery from that point. Now, the strategic asset allocation of these portfolios for Signature and Skeleton, as I mentioned a little bit earlier, the asset allocation is controlled by us, whereas the Synergy portfolios on the local part, it's really up to the managers, how much equities versus bond and cash they want to invest in. But as a guide, they, the names of the portfolios, as I mentioned, are indicative of the equity allocation. And what I wanted to just show you on the slide is, if you look at, for example, the 40 portfolios, strategically, they hold about 25% in South African equities. And if you add this 25% with the amount that is held in global equities, that is how you get to the 40. Likewise, in the 70 portfolio, for example, we've got 48% in South African equities strategically, as well as 22% in global equities. So that gives you then the 70%. The Synergy, because the asset managers control the asset allocation, we only know the true real asset allocation at month end when they report the asset allocation to us. But so it is more of a guideline, and it can sway depending on their decisions in the markets. Now, just as a reminder of the manager's allocation, I see something has happened with, I don't see my camera anymore, but I hope you can still hear me. The Signature and Skeleton, as much as we control the asset allocation, what is different is the manager selection. So the Signature and Skeleton range of portfolios will have exactly the same asset allocation, and the differences are that in the Signature range, we use both active and passive strategies. So if you look at the equity managers on the left-hand side, for example, you've got the Sygnia Swix tracker, which is a portion of the local equity component, as well as a number of active managers. These will be ABAX, 91, and Coronation. Likewise, in the fixed income space, which is your bonds and your fixed income instruments, you've got the Coronation Strategic Bond Fund, which is very much active, and you have the Sygnia Passive Bond Fund, which is passive, simple index tracking, and the index that we track is the All Bond Index. And then on the international side, the international makeup of the portfolios are exactly the same across all three ranges, and they're made up of a number of strategies that give you exposure to, various regions, various sectors such as tech, various themes such as healthcare. Now, in the Skeleton range, exactly the same asset allocation as Signature. However, there's no active management, so there's only passive strategies. So in the equity space, you don't see the names of ABAX, 91, and Coronation. It's simply the Sygnia Swix tracker. So this is a totally passive portfolio. It is a low-cost portfolio, and we know that costs are really important in retirement funds, as members' experience really is the net of fee returns. That is what they truly earn on their portfolios. And the offshore, exactly the same across all three ranges. And then in the Synergy range, The manager selection is Allen Gray, Coronation, 91, and Prudential, and you can see that different percentages allocated to each of these managers across the range from 70 to 40, and on the offshore side, it is exactly the same as the other ranges. So let's have a look at performance to 31 July. This is the performance of the markets. Thereafter, we'll move on to the performance of your portfolios. We'll have a look at the performance in the surveys, and then I will get to the slides and the content that I have prepared to unpack risk of the portfolios. So if we look at the performance over the short term, and 1 year is really the short term, in retirement funds, we really should be thinking 10-year plus. We should always be focusing on the long-term performance. But nevertheless, if we look at it over the shorter term, and I'll look at the 1 year because 1 year is included in the surveys as well, you'll note that the JSE SWIX index has given us 20.9%. Now, this is the index that we track in the local equity portion of your portfolios, and this is an indication of what South African equity markets have done over this 1 year. If you look a little bit further down, you'll see that listed property has outperformed equity. So the JSE SWIX index gave us 20.9, whereas the listed property has given us 28.5%. Now, our range of portfolios are not investing in property at the moment, so we have not enjoyed this 28.5% over the year, but we still hold our view that it's better to have avoided property as an investment asset class in those portfolios, because in 2020 property was one of the worst performing, in fact the worst performing asset class. It has been for a number of years. If you have a look at the 3-year number and the 5-year number, these are still negative. So the portfolios have benefited from not holding property over the long term. And also if you see the shorter term figures, very short term, just for the month of July, as well as the 3 months, property is returning negative again. So this really is a story of coming off a very low base, very deep in the red in 2020. Some investors wanted to, get in on that opportunity that the property market was so deep in the red, and they have invested in some asset managers, pumped money into property, and then the share prices have gone up. So no property in our portfolios, which will explain some of the 1 year numbers relative to peers. We're also slightly underweight South African equities relative to our peers, and we hold more on the offshore side. Now, another move that we made in 2020 was to reduce cash in favor of bonds. And if you look at how that has worked out over the last year, bonds have given us 13.9%, whereas cash only 3.9%. So you would have been 10% better off being invested in bonds rather than cash. The portfolios are overweight bonds and underweight cash, so we have benefited from that move as well. And then on the offshore side, looking closer to the bottom, you will see that investments outside of South Africa have returned in rand terms lower return than your local equity market. That's more than 20%. We know that when we invest outside of South Africa and we calculate that the return of that investment back into rands, when the rand has strengthened, then it does impact the rand return negatively. But the opposite is also true. When you have rand weakness, your offshore building block in rand terms provides even higher returns. So the offshore building block has added nicely to portfolios. These are still positive returns, however, not as high as the local market in rand terms. Now let's have a look at the performance across all of the measurement periods, and this is relative to peers. Now over the 1 year, we can see that the Synergy portfolio has performed the best out of our 3 ranges, and it has done quite nicely relative to peers. The Signature portfolio also not too far behind at 14.2%, and the Skeleton 40 portfolio over the 1 year 12.9 further down to the bottom. As long as we understand the reasons over the short term, and as I said, 1 year is very short term in a retirement fund context, and this really is a story of having a little bit less equity and no property in the Skeleton and Signature range relative to our peers. So some of the portfolios that have had higher allocations to property, they have benefited from that 28.5% over the 1 year. However, we have seen that the performance has been negative over the last couple of months. Nevertheless, let's look at the performance over the longer term, and the longer term is really what matters in a retirement fund. Over 2 years, the Signature 40 fund at the top of the ranking tables, the Skeleton 40 a couple of basis points lower, giving us 10.8%, and the Synergy 40 giving us 9.5%. Over 3 years, Signature 40 fund on top of the ranking tables, with Skeleton not too far behind, and Synergy a little bit lower at 8.2. And then over the long term, you can see that the Signature 40 portfolio has been the best performing over the 5, 7, and 10 years. Anything longer than a year, any return longer than a year has been annualized. So if you look at the 10-year return of Signature 40, for example, that 11.5%, had you been invested in Signature 40 for the last 10 years, your return would have been 11.5 per year for the last 10 years. And this is gross of fees, before fees have been deducted. Now, looking at the 50 fund, comparing it to similar portfolios, these are the low to medium equity type of portfolios. We can see over the 1 year, our 50 range of portfolios at the bottom of the 1 year ranking tables. But again, this is a property and underweight equity story. But over the longer term, performance a lot more consistent with the 2 and 3 year returns. We are second in line, and then over the 7 and 10 years, the long-term performance that really matters, we can see that the Signature 50 fund is at the top of the ranking tables against peers. Very similar picture for the 60 portfolios. This is the medium equity survey, further down the bottom over the short term, over the 1 year, but over 2 and 3 years, you can see that the portfolio ranges at the top of the ranking table, and importantly, over 5, 7, and 10 years at the top of the ranking tables. What you'll also notice is that we don't have 10-year figures for Synergy. This is because the Synergy portfolio range was only launched in 2012, and you have to have real actual returns to be a participant in these surveys. You cannot submit some back-tested simulated numbers. It has to be a real track record. Alexander Forbes prepares these surveys, so they're totally independently prepared and verified. And then the 70 portfolios. So the 70 portfolios, arguably the most important, as I've mentioned a number of times, members may spend many years in these 70 portfolios before they start transitioning into the more conservative portfolios 6 years before retirement. So again, over the 1 year, the Synergy portfolio done really nicely at 20.8%. The Signature and Skeleton a little bit lower at 18 and 16.2. And in the high equity space, this is where being underweight equity and not having any property as a proportion of the portfolio does make the biggest difference. We still, as I mentioned, we hold our view that we believe it was, it has been the correct decision from a portfolio construction perspective. Over the long term, we have managed to avoid the negative returns of the property sector, so it has worked out in the portfolios. So focusing on the longer terms, which is even more relevant in these portfolios, in the 70 portfolios, we can see top performance across the ranges from 3, 5, 7, and 10 years. 10 years, the Signature 70 fund has been the best performing track record. And then always interesting to compare against the single managers, not always a fair comparison, but Coronation, for example, is included in your Signature range as well as your Synergy range. So that's why I say it's not always a fair comparison. The life stage ranges that we are discussing today are very well diversified, multi-managed type of portfolios that include a number of underlying asset managers other than the Skeleton, which is totally passive. So it's interesting, nevertheless, to compare the performance, although not necessarily a like-for-like comparison. We can see that over the 1, 2, and 3 years, Coronation has been the best performing asset managers. They've, done really, really well. They make all the right calls, when moving between certain sectors and rotating the portfolio between locally and offshore. So they've done really, really nicely. The good news is, as I mentioned, Coronation is actually one of the managers in Synergy as well as Signature. So those portfolios have benefited from the good performance of Coronation. Over the 2 years, we can see that both Synergy and Signature are just behind Coronation, and these portfolios have outperformed so many of the single asset managers. A similar picture over 3 years. All of our portfolios are pretty much at the top of the ranking tables, just behind Coronation, outperforming many of these, very knowledgeable and very well-established asset managers, such as 91, which is the old Investec that rebranded to 91. Over 5 years, similar situation with Coronation at the top of the ranking tables, and our range of portfolios not too far behind, outperforming many of the single asset managers. Over the seven years, the Synergy portfolio has been the best performing, and over the 10 years, the Signature 70 portfolio is only 0.1% behind Coronation. On a net of fee basis, this would look very, very different. And on a net of fee basis, the Signature 70 portfolio would actually outperform Coronation. So the portfolios have done really nicely against both multi-managers as well as against single managers. Now, it's all good and well that we focus on the return. So we're comparing this one's 11% versus that one's 10%, but that is just looking at one aspect, which is the return. The return, very important, as it really is the return that will determine whether you're able to retire comfortably and how much your money grows over the long term. But let's consider the risk. So you wouldn't want your portfolio to be taking on an excessive amount of risk. A lot of risk is, as I mentioned earlier, it really is the risk of capital loss. So ideally, we would want really good returns from portfolios at reasonable levels of risk. Now, the investment theory, as I mentioned a little bit earlier, does tell us that the higher the risk, the higher the return over the long term. So essentially, the risk-return trade-off is about your potential return increasing with the increasing risk, and investors expecting lower returns out of asset classes that are less risky. Now, the risk appetite of investors is dependent on many things. And in a retirement fund, the most important indicator of what risk a member should be taking on really is an investor's years until retirement. So if a member has many years to retirement, they can stomach some volatility, they can be invested in riskier asset classes, and they will benefit from that over the long term. Whereas members that are closer to retirement cannot stomach that volatility. Maybe they wouldn't have enough time being invested to have markets go down or have a bit of a crash and recover. You maybe don't have, depending how quick the recovery is, potentially members don't have enough time to recover that, and that's why they should be invested in safer asset classes. The older members' investment strategy will also depend on what they plan on doing after retirement. That is why it's advisable for members to be speaking to their financial planner a couple of years before the actual retirement date to establish what they plan to do with their savings beyond retirement, as depending on what the post-retirement investment strategy may be, it may very well be worthwhile for a member to actually stay invested in a high-risk type of portfolio right up until retirement. But, a lot of words on the slide, but essentially, as I have mentioned, longer time horizons allow for higher risk, and members with a longer time horizon should be invested in higher risk portfolios in order to get more returns over the long term. One of the most popular measures of risk is standard deviation. So standard deviation is a common method to determine the risk of the portfolio. It's essentially a measure of market volatility. It's a measure of the spread of asset prices from their average price. So if you look at a portfolio's return on a month-to-month basis, for example, or on a day-to-day basis, depending on your kind of volatility measurement period. But because when members are investing in shares, as we have mentioned a number of times in this webinar, share prices moves up and down. There will be an average where these movements take place. So the more dispersion there is away from the average, the higher the standard deviation. So if the average return is, say, for example, 5%, if one day you're getting -10, the next day you're getting +15, the next day you're getting +2, then a -12, there's a big dispersion around that average value. Then you'll have a high standard deviation. Whereas, again, as a simple example, if your average return is 5, but the movement of the returns are only to 6 or 7, then to 3 and 4, so they're closer to that average of 5%, that means the dispersion is less, and that means that the standard deviation will be lower. So in statistics, standard deviation is the measure of the amount of variation or dispersion of a set of values. So a low standard deviation indicates that the values tend to be close to the mean, close to that average, while a high standard deviation indicates that values are spread out over a larger range. So you can expect, big deviations from that average value. I've included the formula here, but essentially standard deviation is measured by, calculating all of these values minus the mean. You sum that and you square it over the number of, returns or the number of values that you are averaging, and it's the square root of that. So that's essentially the formula, but in simple terms, we're simply trying to measure the volatility or the dispersion of returns around the average value. We often show this slide of risk versus return. So risk is measured by standard deviation, which is what I've just explained in the previous slide. So it really is about the dispersion around the mean of these returns. Now, as expected, the lower risk portfolios, which are your 40 range of portfolios, are further to the left. So they take on a lower risk, they have a lower standard deviation. You don't expect their returns to be very, very far from the mean, whereas the higher risk portfolios that invest in a lot more risky asset classes, we can expect a bigger dispersion in the returns of those portfolios. So if we have a look at the full range of our 40 portfolios, we can see that they're lower on the risk spectrum, but they're also the highest performing portfolios for that level of risk. So for every level of risk, you want the top performing portfolios. So we can see that this range of portfolios, the Signature 40 has given us the highest return for that level of risk. And relative to these portfolios that plot underneath, so looking at this net group excess guaranteed or AF medium conservative growth, these ones have taken on the same amounts of risk, but looking at their corresponding return, they have not been rewarded for that risk taken. I'm not going to go through every single one of them, but let's focus again on the 70 portfolios where we do expect members to spend the majority of their working lives. These portfolios have taken on about 9 to 10% of risk, depending on whether you're looking at Skeleton, Synergy, or the Signature range. But let's look at Signature. Signature 70 fund taken on about 9% of risk. 9% is the standard deviation that has been measured for this portfolio. And for this level of risk, it has been the best performing portfolio. Anyone plotting underneath has taken on the same amount of risk, but simply not delivered such a high return. Now, the portfolios that over the short term now are at the top of the ranking tables are much higher on the risk spectrum. So you would have noticed that a lot of these momentum portfolios that have a higher allocation to property, for example, they've done really nicely over the 1 year. Their property allocation has helped them. But on the risk spectrum, because they hold more property, they hold more equity, they hold more, risky asset classes, they're further to the right, so they're riskier than the SURF default range of portfolios, these life stage portfolios, and over the long term, this is a 7-year scatter plot. They simply have not delivered the return over the long term. So we looked at return only, and now looking at risk and return, again, we're showing that these portfolios have done really nicely for the level of risk that they have taken as measured by standard deviation. Now, there's many other risk statistics that can be calculated, and there's simply not enough time to go through each one as a formula. But if you look at this range, which is the range of life stage portfolios, starting with the more aggressive ones suitable for younger members, the higher growth type of portfolios, the 70s, right through to the 40s towards the right-hand side. If we look at standard deviation, which is the measure of risk that we have just spoken about, standard deviation is higher, so these are seen to be higher risk, giving us higher standard deviation numbers than your 40 portfolios. Your 40 portfolios have lower standard deviation numbers. A few other things to point out, and this will then reiterate the fact that the higher the risk, the higher the return over the long term. We can also calculate the best month in terms of performance, the worst month in terms of performance in the history of these portfolios. This is calculated over the last 5 years, so over 60 months to 31 July. Now, if you look at Synergy, a higher risk, more allocation to equity, suitable for younger members, the best month, 11.3% return in a month, whereas the Signature 40 fund, when markets are doing well, you only have 40% in equities there, so you're not enjoying, the full, investment into equities. It's only 40%, whereas the other one has more than, or about 70% invested in equity. But the worst month is also worse in the more aggressive portfolio. So the worst month in the Signature 70 portfolio has been -10, whereas in the Signature 40 portfolio is a bit lower. And then with a maximum drawdown. So the maximum drawdown is the biggest drawdown from a high point to a very low point. So as markets moves up and down, and again, you can expect a more negative drawdown from a 70 portfolio than what you would from a 40 portfolio, which is a lot more conservative, has a lot more bonds and cash and safer type of instruments, and only 40% invested in equities. And there's many other risk metrics. But the bottom line of all of these risk metrics is similar. You can expect more volatility, but higher returns over the long term from the 70 portfolios, and you expect a smoother ride, although not totally smooth, as you are still invested 40% in equities, but you can expect a smoother ride, less volatility, less negative returns from your 40 portfolios. And then the one last risk metric that I want to touch on is the Sharpe ratio. Now, the Sharpe ratio is often used to compare one asset manager to another. And the Sharpe ratio really measures the performance of an investment compared to a risk-free asset. So a risk-free asset could be a government bond that you use, for example, or a treasury bill, and you're after adjusting it for risk. So it's really defined as the difference between the return of the investment and the risk-free return, as you can see in the little formula, divided by the standard deviation of the investment. So the Sharpe ratio is calculated as the return of the portfolio minus the return of the risk-free rate divided by the standard deviation of the portfolio's excess return. Now, I mentioned that this is used to often compare the performance of asset managers against each other. So what are we looking at? So if we calculate the Sharpe ratio for various portfolios, the higher the Sharpe ratio, the better its risk-adjusted performance is. So having a look at the Sharpe ratio of various portfolios in the industry, what was used for the risk-free rate here is the 90-day treasury bill, which is at about 3.89%. We can see that in the low equity space, our range does have some of the highest Sharpe ratios relative to other competitors. Similarly, in the low to medium equity space, some of the highest ratios relative to competitors. The Signature 60 portfolio does have the highest Sharpe ratio when measured against its peers, with roughly about 60% allocated to equities. And in the high equity space, a lot more competitors there. We can see that our range of portfolios do have some of the highest Sharpe ratios. So this then brings me to the end of today's session. Thank you very much for joining the August webinar, and I'd be happy to take any questions. I don't see any questions in the question box. If there's anything that you would like further clarity on later on, please feel free to get in touch with me on email. And I will be happy to assist you. This recording will be saved on our website. All of our webinars are saved on our website. So if you ever want to have a refresher, or sometime in the future risk comes up again, and if you think that this presentation would have helped you, then you're welcome to go and listen to it again on our website. Thank you very much.